All right. Hello, everybody. Thank you for joining us. I'm going to give it a second so that everybody can get in here and make sure everybody can hear us. All right. Hello. Thank you all for joining us. This is our Housing Equity Through Financial Education webinar today. We've got some very exciting things to talk to you about. Before we get started, we're going to run through a little bit of housekeeping. We are recording this. It will be posted on our website once we're done. So everybody, if you need to leave or anyone that couldn't make it, we'll be able to share that with them later with members. This is a webinar, so the Q&A is available to you, but not the chat. So if you have any questions, please feel free to drop those in the Q&A. All right, we'll go ahead and get started. Okay, first thing, I'm going to read a quick disclaimer. The information you're about to hear is for general information purposes only and is not intended to be legal advice. Please keep in mind that every situation is unique and the laws, rules, and regulations may have changed before, during, or after this webinar. Before acting, please be sure to obtain tax and/or legal advice from a licensed professional. The opinions and viewpoints expressed during this webinar are those of the presenters and do not necessarily reflect opinions or views of EBRHA or its members. All right. First I'll start off, I'm Danielle Baxter with EBRHA. I'm the sales and member relationship manager here. I've been here for about 5 years. I'll introduce myself in a second, but just so you know who's talking to you. I want to go over a few things first, just some EBRA things. We do have some promotions going, so if there's anyone here, which I do see quite a few actually guests, if you're not yet a member, there's a lot of incentive this month to join. The theme for February is equity. We want to make sure that membership is accessible to everyone. So we have a promotion going, and you can save $100 on membership. But you also do get a $40 credit when you join. So if you want to attend any future events or anything like that, that costs money to members, you can use your credit on that. And then for the members that are with us today, if you have anyone that you think might need membership, you can refer them, and we do give credits for referrals. So let us know who you send our way. We'll try to make a good impression. And then make sure that you get your promotional referral credit once we're done. And then this is the equity and housing promotion I just mentioned. You can save $100. If you're not yet a member, please join, use Equity 100, and give us a call if you have any issues with that or you don't see an option for that. For the members in the room, we also do have committees. We have openings on all of our committees. If you're not already on your phone, you can scan this QR code to go and learn more about the committees and apply. If you are on your phone and you can't scan the QR code, you can reach out to us and we can give you more information. It's also on the website. But we have several committees. We're always looking for new voices. The committees come up with everything that we do, our forums, our programming, events, the legislative policies and advocacy, all of that good stuff. So please, if you want to get involved, the committee is a great place to start. Next, and I'm so excited about this. I've been working on this personally, me and Jaw, who's also here with us, working on the EBRA Academy. We're going to be launching this officially on March 1st. We have a good little selection of courses that we've been working on that are gonna be available at launch, and this is going to be constantly growing. It's on demand, learning at your own pace. Pretty much everything that we talk about in webinars will be available for you on demand in like small digestible pieces. So you don't have to watch a whole 90-minute webinar to get the information that you need. You can kind of go through the course. And there's little quizzes and things to make sure that you're, reading everything and checking it all. But there will be incentives in this as well, fun ways for you to learn more and get more involved with EBRA too. So we'll be talking about a lot of these courses. A lot of the courses that are in EBRA Academy will come to life in webinars too, if they weren't already based off webinars. So it'll be a nice kind of engaging experience. Again, launching March 1st, super exciting. All right, and we have some upcoming events. We do have a networking mixer tomorrow in our office from 5:30 to 7:30. And we are going to have Alameda County HCD there doing a presentation on one of their new programs. So that'll be really fun. We also have a roundtable on March 10th, our monthly roundtable with our board president, Wayne Rowland. And then it's that time. EBRA Next Housing Innovation and Technology Conference is coming up in May. Registration is open for that event on the website. So if you want to go and check that out, it's going to be in Oakland this year. Okay, and it's now time to introduce our panelists. So today we are talking about housing equity through financial education. We have some experts in the room that will be helping us with that conversation. First, I'd like to introduce Felicia Favroth. I hope I said that right.
You did.
12 years as an Oakland-based real estate broker. She's got a ton of experience, true calling and entrepreneurship. So she not only owns multiple rental properties, but thrives on the financial and personal freedom of running her own skincare business. She's driven by passion, purpose, and the freedom to build something of her own. We have Steve Wilkinson with us. Also, many of our members know him. He's been in a lot of webinars with us. Experienced financial advisor, member of the court of the table, and chairman of the board of directors of the Northern California Small Business Financial Development Corporation. That's a tongue twister, Steve. I like it. We have Gabriel Galliots, investment advisor with a demonstrated history of working in the commercial real estate industry, skilled in apartment sales, real estate economics, investment properties, and real estate transactions. Again, he's been with us for plenty of webinars, so it'll be another friendly face. And last but not least, Walter Brown, who also has been with us for several webinars before. Financial service expert. I could go on and on. 30 plus years of experience in the financial industry in all phases, mortgage management and operations. He writes articles, provides interviews for broadcast radio and other media outlets. Walter assists consumers, financial institutions, and state and federal officials by providing ongoing financial and technical advice. Very qualified individuals with us today. And so what I'd like to do is just talk a little bit about myself, and kind of my experience getting into the industry and home ownership. I wanted to start it off because we're going to kind of break this webinar into three parts. And first, we're going to talk about just how to get into home ownership. I know we have some guests with us, and there's a life cycle of owning property. 5 years ago, when I first started with EBRHA, I was a renter in the East Bay, and home ownership felt so far away for me. Maybe someday. And it felt complicated and expensive. I didn't know what I didn't know, and so I just didn't know what questions to ask, and I felt like it just wasn't for me right now. Little intimidating. I came on board with EBRHA, and I started being, sitting in these conversations where everyone was talking about interest rates and credit and lending and long-term planning. And I was like, oh my gosh, I thought like I already felt, intimidated, but I really it hit me how much I really didn't know. But because I was in a room with all of these experienced experts, I started asking questions, just kind of lobbing things off of people. How did you get started? What was your first thought? Who did you talk to? How did you learn all this stuff? And I listened, and within a year of being with EBRA and before I turned 30, I ended up buying my first home. And the biggest shift wasn't even money. I realized like that felt like my biggest hurdle, but it wasn't. It was really education, just understanding what ready really felt like, what it really meant. And even though I didn't feel like I was prepared, I was, and I was able to accomplish a lot more than I thought I could. And so that's what this webinar is all about. I'm really passionate about it because of my journey and building a better life for my kids and just kind of getting into this industry and just not realizing how much mentorship really happens here. And so I'm fortunate to be in a room with all these professionals and be able to share their expertise with you. It's really exciting. And without further ado, we'll go ahead and dive right in. So I'm excited to pass it to our panelists. I think we're going to get them spotlighted here pretty soon. And we're just going to run through some questions that I know a lot of our members and a lot of our guests probably have. And then let me go ahead and take this down here. So I'll stop sharing my screen so you can see everybody. All right, let's move you guys over. And again, if you have any questions, please feel free to drop them in the Q&A. And we'll go ahead and get started. So the structure of the webinar today, first we're going to talk about before you own, preparation. We have a lot of questions that go into that. Then we're going to kind of dive into once you own, how do you sustain that and how do you protect your investment and maintain your property? And then last but not least, when the time comes and you're ready to pass on your property, what do you do? How do you build a legacy? A lot of our members turn and sell, and we, have grown a lot, and we're trying to have those conversations of how you can actually convert that into a legacy, build generational wealth, and just do different things with your assets. So we'll talk about all that today. Um, the first thing that we'll dive into is how to prepare. And the first topic in that is economic readiness. Some of the questions that we've been getting, and I can start off just with the first one. The economy right now feels kind of like a war. And what does that mean for someone that's considering property ownership? How do they navigate that?
This is Walter Brown. Hey, in regard to that question about the economy and what it feels like, I'd like to just open by saying the famous investment guru uh, Templeton was his name. He said, "When there's blood in the streets, that's the opportunity. That's the time to buy. That's the time to buy." And so, when you're talking about war, there's blood in the streets. It was Warren Buffett who said, "When people are afraid, that's when I'm greedy. That's when I go in and buy." And so right now, while you have a economy that is a bit unpredictable, people are watching it very closely. Uh, when you look at what's happening in Washington D.C. and what's happening internationally, that is actually causing a lot of folks to hesitate in terms of making a purchase. And so whether a person is looking at buying their first home or buying an investment property, this creates a market where bargains can be found. And that's where, folks have to do their do's and don'ts protocols before getting active in the market.
Okay, I'd like to say that if you look at, I have international global real estate returns. I have a chart on that, but anyway, and it'll show that we're at a point right now where real estate appreciation is getting ready to cross the line to the positive upside. Real estate went down, and all real estate got dinged when interest rates went up in 2022, and we had probably about a 25% decline. And since that time, it's been steadily climbing back. And if you looked at the chart, you would see that, the real estate had its biggest bottom, of course, after 2007. And then it climbed back up until really it kept climbing until we got to the pandemic. And then it had a decrease, but it recovered quickly. And also, then the decline since 2022 had to do with the raise in interest rates. You had low term, zero interest rates almost continuously since 2007, 2017, when the current Fed chairman came in. Interest rates were raised briefly. That was when Trump first got in office, and we had a decline. But as soon as those interest rates came back down, we had a continual increase. And if you saw the chart, you would see that it's getting ready to go on a positive side of appreciation. And you would see during that whole period that income was steady. That's what's great about real estate, is that income, given, operating correctly, you will have a steady income, should have a steady income of 4 to 5%, which makes it a good alternative to bonds, and with some different tax benefits than the bonds have. And basically, and then appreciation for the steady investor, real estate's going to appreciate because it's an asset. We're in a capitalistic economy, and you get wealthy by owning assets in a capitalistic economy. All the tax laws and everything and how the economy works is for those who own assets, who are not the pawn of the system. If you don't own any assets, you're the pawn of the system. But when you own assets, you're the rook, the knight, the king, the queen. So it just depends where you're on the board, but you want to own assets. So for the patient investor, the returns are there. Uh, and the key thing doing an uncertain economy and the war, some financial experts feel like the markets are trading right now as if they're expecting war. So we are, because of the current administration and their policies are at the precipice of, potential wars. And so that's why you see gold up. Uh, and unfortunately, you see Bitcoin down. It was supposed to be a store of value, but it's proven not to be. But gold and commodities have done well. And also, you see liquidity up. So, real estate is a liquid asset. A liquid meaning you can't sell it right away. You can't sell it that day, the next day. And if you try to sell it quickly, you're going to take a haircut. You want to sell real estate in a prudent fashion. So, doing terms where there might be trouble in the economy, you want to have higher liquidity because liquidity gives you the staying power to ride out storms. It's just like adding additional ballast to your if you're selling or trimming the sails, the things that help you ride out a storm. And so liquidity is that stocks, bonds is considered liquid CDs, money markets, cash, savings accounts. You want to be able to ride out the storm if cash flows are impacted, like they were doing for a lot of property owners during the pandemic. Also, they were impacted in 2007, 2008. If somebody had liquidity, they could have held on to those assets and not lost them during that period, and thus participate in the appreciation you saw for the next 13 years. So that's what you want to do is look at across your assets, how much liquidity did you have, and balance that liquidity toward the obligations that allow you to hold on to those assets if something impacts the cash flows.
Yeah, and Stephen, you mentioned interest rates, and I'm curious for Gabriel too. When someone's thinking about buying, what is the most important thing to look at in the market? How do they know if they should buy now or wait? Is it the interest rate or something else?
Um,
Well,
to me,
go ahead. Yeah.
I'm sorry. I'll be short. To me, there's a couple of different factors that will go into when a decision to buy. Also it depends on the product type as well too. Right now, interest rates and Walter and Stephen could probably correct me, but interest rates are hovering around 6% interest rate, and a lot of people feel like they missed out in 2022 when interest rates dropped down to 2 and 3%. Um, I can't see it getting back down there again, but also too, especially here in the Bay Area, you're going to get a lot of appreciation when you buy property here. Value always is going up. It's a very attractable place to want to own as well too, or rent as well too. So you're always going to find tenants, and you're always going to have appreciation in your building and things like that. So just depending on what your situation is, let's say that you are wanting to expand or get into more investment properties or bigger investment properties, or maybe downsizing. I know I've talked to a lot of different clients where they're just waiting for the market to come back. But if you are buying, this is the perfect time to buy. It might not be the perfect time to sell, but when the market gets back a little bit better, it's going to be a perfect time to sell. It might not be the perfect time to buy. So just kind of everybody has a different situation at different timing.
Thank you for that. Um, And what's the difference between, I want to kind of talk about debt too, because I know that building credit and having savings and things is really important to getting into a position to buy. What is the difference between private debt, conventional lending, and bond related financing as well, and when is each appropriate?
Well, when you look at conventional debt, uh, oftentimes people will be referring to financing from Fannie Mae, Freddie Mac, FHA, uh, the VA, when we're talking about 1 to 4 unit residential or first time buyer uh, situations. In looking at commercial real estate situations, and Gabriel probably has a lot more information on that to add, but that would be, bank financing, commercial paper, banks lending on an amortized basis anywhere from 5 to 10 years, sometimes 20 years, depending on the quality of the credit. And then going into the private side of things, that would be more of the pension fund, family trusts, where the lending guidelines would be more flexible than with Fannie Mae or Freddie Mac. and also more flexible on the commercial side as compared to a Chase Bank or a Bank of America or a commercial lender. In addition to that, the bond financing programs, we have those that come out from the cities and states from time to time. Those are very limited in their dollar amount. The state of California has a program that everyone is watching for right now. I think there's a lottery and it ends on about March 10th, as I recall. That's out of the state of California where a $150,000 grant can be won and given. We've worked with that program in the past, and however, and that's the California Dream for All program. And so, if one were to look at that, it's sponsored by the California Housing Finance Agency. That's a very popular program, but the money is very rare. And so, there are other programs that either out of Alameda County, San Francisco County, um, places around the state where folks can access. But it really comes down to one's team. When we're looking at timing, the quality of the team, the advisors, that your real estate agent, your loan officer, your tax preparer, your family attorney, those folks are going to really be able to create a good environment or a better environment than just any one particular aspect, be it interest rate or market price entry points. That would be my opinion.
Yeah, that makes sense. And what,
One
go ahead.
I wanted to add one thing. One thing that I've been seeing, especially in commercial real estate, that's been popular is private financing and owner financing,
Mhm.
where the seller would carry some kind of note in the first or second position to be able to purchase these different properties. And that's been a little bit more attractive because of interest rates has been jumping up, and some owners just want the deal to go through so they can still get the actual price point. There's also some tax benefits, and the others on their panel probably talk to the tax benefits of owner finance as well. But that's definitely been a more popular financing option for people buying as well too.
Yeah, and Gabriel, you mentioned appreciation, and I know when investors are thinking about growing their portfolio, sometimes it is a financial stretch. And when do you feel that that financial stretch becomes dangerous? Is there some kind of threshold or other blind spots that, smaller new investors don't really think about?
Um, I would say when people are trying to time out the market and figuring out when that appreciation is going to happen, when the market is going to start turning. Like we was talking about COVID in 22, when interest rates were a little bit lower. Nobody expected interest rates to start jumping up, pretty much doubling within the same year. So there's no real time that you could predict when things are going to happen, when appreciation is going to start slowing down, and interest rates are going to be coming back down as well too. So it's just like looking at a crystal ball and trying to figure out when is my building going to be worth this amount of money. Like it might just never happen. I always say, depending on your family situation, depending on what you have going on, um, if it's your time to move and react a certain way, it might just be time just to do it versus just waiting. The market's going to come back next year. The market's going to come back in 2 years, and just hold out. But you have this tenant squatting in your building, and you don't want to pay for, the eviction and stuff like that. So like, it
Mhm.
just all depends.
And we do have a question in the chat actually, kind of on this topic too. And so if you already have one rental property, what's the best way to use that to purchase another rental property if you don't have any capital?
The If I heard the question correctly, you have one rental property. What's the strategy to buy your next rental property if you do not have capital?
Correct.
That's where, in my mind, that's where Gabriel's comment really is valuable. There are situations that come up where sellers may be very motivated to sell and may offer creative finance opportunities. But there's going to be some capital that's going to be needed to make the
Yeah.
transaction go. And then the other piece of that is if a person doesn't have any capital, that uh, they may need to wait, right? I mean, sometimes it's easier to stay out than to get out. And yeah, yeah, and if they get into a situation where they've got another property, but they don't have 6 months to a year worth of expenses saved up, and they have a major repair like with the rains here recently. I know a
Yeah.
lot of us have had to have our maintenance teams go out and fix some leaks and things like that. Well, that costs money, and so not having any liquidity, there may be a need for them to go back and be honest with their budget and reassess what their monthly expenses are and look at where their incomes are coming from and what they can do to gather more reserves. That would be if a person doesn't have liquidity, that's kind of a red flag that they they need to really be careful.
And I'm going to jump in here about that too. Maybe coming more from the standpoint of being a small landlord, you don't want to be house poor. You don't want to be house rich and cash poor. And so, though it may look like it's, sexy on television, everybody's like, oh, I got 20% equity in this house. I'm going to take it out and buy another one. They don't talk to the days of when, like Walter talked about, when you need a new roof, when the tenant doesn't pay, when, you need to put 40, 50, $60,000 in, or you're going to lose the property. Or if sharks smell blood in the water and they know you are stretched, it's amazing how easy you can get taken advantage of. So don't believe what you see on Instagram. They got to have a little bit of money. Okay. Because I see it all the time, having been a real estate broker and selling, single families and stuff like that. You got to be able to afford it, and you got to be able to afford it when the chips are down. And you got to be able to, and you may not be able to buy in the sexiest place. You may have to buy in a place that in 10 years is going to turn around. So always keep in mind, can I afford this if the tenant doesn't pay?
Yeah.
Do I need to be in this because everybody else is in it? You have to think about, can you take the stress level? Not everybody can take that stress level. So
Yeah,
it's
and
brutal.
I know in the conversations that I had, sometimes it's, purchasing property is not always straightforward, right? And there's a lot of opportunity where you can collaborate with another owner or do something like that to get like a duplex or triplex and kind of make some connections and make things work, owner financing from other legacy owners, things like that. And then one thing I wanted to ask too, it popped into my mind is if can you stack bank or municipal programs to help with like down payments or things like that? And how does, Felicia, you mentioned another one too, kind of using equity loans and things like that. How does all that work?
Oh, that can get complex. Now, when you're talking about, are you talking about buying your first home and you want all these first time home buyer programs and so forth? And maybe this is a Walter question. I would say this: you got to be able to afford it. Yes, you can stack probably some programs, but and when you start thinking about working with others like partnership to buy something, you also have to realize it's like getting into a marriage. How many people do you want to date? How many people do you want to marry? Who do you want to be in a polygamy relationship or not? So be very careful about what it's going to take for you to get that property. And if you've got to have 5 partners and stack 3 or 4 different things, the stress alone and the fact that you're teetering, all it takes is one COVID, one bad situation. So I would say this: if you're just now starting out and you haven't been in the game that long, make it simple. It's like investing. If you've never invested before, don't get into Bitcoin. When you're doing housing, make it simple. If you cannot explain it to a child, don't, my opinion is don't do it. Wait to do it your third or fourth or fifth time. But yes, there are probably some things that you can cobble together, but try not to make it so complex that it will fall if one thing gets pulled out. Or if you get into one argument, it's not easy working with partners. It's not
Yeah.
easy working with family too. I didn't see that question.
We're gonna get to that one too. The
I like
family
to say
inheritance,
something.
yeah, for sure.
I like to say something on that topic real quickly. Um, and I think that's great insights from Felicia. The key, one of the key things you think about is if capital follows deals. So if you have a great deal, an opportunity, then that is when you should take aggressive action. For some reason, somebody's giving you a great opportunity. Like I was talking to a young lady recently whose landlord, who owned a large commercial building uh, in a very exclusive city and neighborhood, wanted to sell the building to her because he appreciated who she was, without any cash down, really. And a building that this was discussing, it was 25 years ago. That building would have appreciated $10 million by now. But she
Hmm.
didn't go to the ex, she was not comfortable to do the deal, so she didn't take the deal. He was like, came to her with this deal as part of his estate planning.
Hmm.
And she didn't go to the experts to find out, well, how to do it. So first of all, if you have a great deal, capital will find you, and but you still need to be able to negotiate, right? Because the sharks, like Felicia said, will take your deal from you.
Yeah. And sometimes it feels too good to be true. I mean, I know on my
Yeah.
journey there were a lot of things I was looking at. I was like, no way. I can't pull that off. And it's like, someone sat down with me, they're like, no, you really can. Like, give it 6 months. You could do this. And so
Yeah.
it is, a lot about patience too. But like you said, Steve, like if you got something in front of you that's just too sweet, like the interest rates in 2021, you got to find a way to make that work. So yeah. So I want to kind of
Also,
transition in. Did you have one more thing?
now I was going to add too. Also use your resources around you,
Yeah.
especially like on the channel here with EBRA. I've been a broker for 12, 13 years, a property manager for 12, 13 years, and I've called EBRA on just the simplest question about a lease agreement and what should I do? Because you never know enough stuff, and it's good to have the network to be able to call a hotline and ask a simple question of the newest rule about SB 721 and get a referral for a balcony inspection. So definitely use the resources around you, especially networks like this as well too.
Thank you, Gabriel. Yeah, that's a great point, and it's a perfect segue actually, because I want to talk now about how to maintain and strengthen your investment once you own property, and how to plan to build capital so that you can grow your portfolio. So diving into that, the first thing is just budgeting and capital planning, and we've kind of touched on that a little bit. But how should owners balance ongoing maintenance with long-term capital improvements to make sure that they're not stretching themselves too thin?
I could start on that one. I would probably just assess what the issue is, depending on the project. Some items might not need the full complete remodel or redone right away. It could be, serviceable to do something small right now, get through the winter or that leaking roof, versus just getting a total new top of the line roof with gutters and all that done right away. Or it could just be the smallest thing of I had a tenant that had a hot water issue where I just wasn't getting enough power going back to our unit, so we couldn't use an electric water heater versus a gas water heater. But just doing like a couple of simple tests of, do I upgrade my full electricity on that particular building, or do I just switch to a gas electric heater, which would be a little bit cheaper, probably be easier or something like that. So like depending on what the situation is, just always assess what needs to be done right away versus a capital improvement. It might be a little bit more expensive down the line to see what's the best route for your whatever project it is.
And if it's something that they could put off, like a large scale upgrade or an actual capital improvement, how would you recommend they kind of financially prepare for that? Um, Especially like mandated compliance programs, like this sudden SB 721, like how do you plan ahead for things like that?
And that's the thing. The thing with SB 721, it came about, I want to say about 3 years ago. And then the end date was last January 2025, and then they extended out a year. And there's no real telling when that's going to happen. I know a lot of owners haven't even gotten the inspection, but January was the first time to do that. But um, it's just hard to plan out and financially what needs to be done because there's a good amount of owners that probably need to do their whole walkway, their whole staircase all over again, which could get up to $100,000, $200,000. And I have clients that, I don't want to deal with this. Let's just sell the building and move on. So there's no real way to kind of plan for that, especially if you just don't have $100,000 laying around to be able to do that inspection. I mean, they got other options of getting loans and helping financially to be able to service some of these projects and things like that. But it's just going to be a tough situation on deciding when to pull the trigger and make these different additions to your property and fixing these different things like different ordinance that's coming about in the city of Oakland. It seems like a new one every couple of months that they're just bringing about and things like that.
Well, from the financial planning side of me, I have to speak. You know, everything in life, with your finances should be around a budget. So your lifestyle, you should know your lifestyle budget. For your rental properties, you should have each property can have a rental property budget, and you can just look at past expenditures and look at what percentage of that was part of your overall income, and then start allocating that to some kind of a fund that you keep around for these expenses that you know are going to come up because you see the history on your property. So if it's 5% of revenues, put that away, and you can put it in some kind of account that maybe might even be invested so it'll grow. So when the you will have some liquidity to deal with those issues, and that liquidity will make it easier for you to get a loan against your property, whatever, if it's a big project.
Yeah.
Okay.
And Stephen, what do you recommend? Like, what level of reserves is actually realistic? Is there a percentage or something that you think is a good rule of thumb?
Well, there again, knowing the history on your property of what you have to spend would give you an indication. And then if you had a reserve that was reserved for a year's worth of those expenses, that would be fantastic. But for instance, with lifestyle, in a period like now with uncertainty, where people are losing jobs and they're not taking at least 6 months to find them, and it might even longer if you're trying to find something at that same income level because of AI. You might want to extend out to a year.
Hmm. Thank you. That's great. Um, so going into, equity and borrowing, we touched on this a little bit, Felicia, and I do want to dive into it a little bit more. When does pulling equity out make sense? I know it's risky, but when does it make sense and when does that risk become unnecessary?
I would say for myself, I would always probably um, think about how much that money is going to cost you and how much that money is going to make you. Now, if you're pulling it out because you've got to put a new roof on and the house is going to appreciate and be safe and you can now keep it longer, great. If you're going to pull it out and do something extremely risky and you can't pay for that and it's going to totally stress you out, you're not going to make a lot of money on it, then I would say don't do it. You don't want to pull equity out unless it's really worth it. There's always that push of everybody else is pulling money out,
Mhm.
everybody else is doing this. You don't want to follow the crowds. You want to say, if I take this 20% out, if I take this 50% out, and it's going to cost me because you're going to take it out, either you're going to sell it, you're going to refi it, or can I pay for the new loan, and will I make more money with the new with the purchase? So don't be scared to do it. Just don't do it because everyone else is doing it. Just make sure you can afford it and that it's worth it. And then make sure you go to either Walter or Stephen or Gabriel.
Yeah, you saved.
I had
Yes,
a,
go
I
to.
had a, I had a question for you, Felicia, actually, to kind of add. I know a couple of clients and a couple of owners do depreciation on their property, and they come with that. How would you plan out that route when you depreciate it for 27 years and you're getting close to the end of that? Like, how would you suggest that clients or owners navigate that situation?
Oh, you're asking me, Gabriel?
Or you or anybody else that are familiar
Okay.
with that? How would you?
I mean, I actually would, there is an opportunity where you can either say, I've got this totally depreciated asset. And do I just want to pull money out just so I can have it and in turn enjoy the money, invest the money, don't even put it back into real estate, just do something with the money? Do you want to trade it in for a 1031 exchange or so forth? Because I'm running into that situation on a personal note where you do have almost no basis anymore. Or you can
Right.
also think about this too. How old am I? Am I going to
Mhm.
die? Relative, not to be morbid, but the reality is if you're in your 70s and you think you can turn it over to your heirs and have it as a get a step up in basis upon death, you may just want to sit on it, pull money out to enjoy it, and then turn it over and allow that heir to now get that stepped up basis and so forth. So there's a lot of, it really depends on the person, what they want to do with the money, how long, why do they want to pull the money out? And sometimes it's okay to have just assets just from a personal standpoint, because you may need to sell it for something for an emergency or so.
Do you think that
Thank
refinancing is still a
To
viable
Felicia's
option in
point,
today's climate?
um, if I may,
Yeah, go
Danielle,
ahead, Walter.
also to Felicia's point around just having assets and not necessarily financing because everyone else is doing it. I posted a recent article from the Wall Street Journal that is pointing out that a lot of folks who went out and did commercial financing, those notes are coming due right now. And so those folks that did vanity financing, they've got some maybe loads to carry right now that they shouldn't necessarily have had to carry. So there's strategic planning and thinking that, as Felicia alluded to, that a lot of folks are doing right now, as pointed out in this article.
Thank you, Walter. Um, Okay, so we do have a question from Mike. Thank you, Mike. So we rent out one property and own another that we live in. Rental funds, both those collected and also those that go out, are put into a checking fund that is also used for general everyday expenses. Is this advised, or is it best to separate funds for the rental property? And would it help with, possible litigation to have them separate? And is an LLC the way to go for one rental property to protect our assets? It's kind of a two-part question there.
Well, I can say you want to have umbrella coverage that you can get from your whoever you get your car insurance or your homeowner's insurance, typically. And that will give you overall protection for all your assets. So everybody should have that has assets. So you have an umbrella policy that is at least $1 million that will protect you. Because lawyers will come for that money. Believe me, I've worked with Willie Gary before and saw him in action. He was a big time lawyer in Florida that he settled 5 lawsuits a day. Um, so then, as far as how you hold your property, wealthy people don't hold their property in their names. They have various corporations and that they have to protect them from that. But then, as far as for your specific situation, it always helps when you have a dedicated fund that you have set up, for particular purposes. So you have to understand your cash flows, and that's where the budget comes in. And so it's easy if you just put everything in a pot, it gets commingled, it's hard for you to track and be able to be prepared for specific situations that come up. So I would keep it simple, but for things that you're concerned about, I would try to separate that and have a separate fund. If you just have attached savings accounts to your thing, you said you put in your checking account for operational things, or move things over to savings for emergency type things. And if that accounts grows too big, you want to have an investment account because you can get better returns in money markets or bonds or whatever than you can in any savings account. Uh, so that would be my recommendation.
Awesome. Thank you, Stephen. Okay. I want to talk more about taxes and building wealth, just handling all of that while you own property. And so, talking about smart tax planning, especially for East Bay rental operators, um, what are some common tax mistakes, especially during economic uncertainty?
The biggest one I've seen is people selling something thinking they're going to get all the money and and spending all the money, and then they get they talk to their
Yeah.
account the next year, so they might have spent it in January this year, but they don't have to file the tax return until, April the next year. And they realize that on that $1 million property they just sold, they owe $400,000 and it's already spent. Um, so that's the biggest thing. You have to realize that, especially with assets, taking liquidity, there's always taxes that you have to consider, and there's ways to. What the wealthy do is they don't, they and why they don't pay taxes is because with the assets they get relationships with the banks, and they just borrow out what they need for their lifestyle, and so that's how they manage and keep their tax bills down. Uh, but Yeah, and then if you're selling a property, you can do a 1031 exchange. It got discussed before, tax free. You have options with that if you want to get out of the property management business to get to be in a passive exchange, and you can keep exchanging and still get the step up later on to pass on to the next generation. And then there's other ways you can do to sell property and defer taxation, but you want to always consider those taxes.
And the other, thank you. And we're gonna do a deep dive in just a few minutes on selling or just thinking about, moving on from your property. But before we get there,
Danielle, can I just piggyback real quick on what Stephen
yes,
was
go ahead.
saying?
Yeah.
Okay, I would say this, and I don't know if you're going to bring this up. The key is also um, hire a professional. So if you got a
Mhm.
question about taxes, hire the CPA. Don't go online. Don't do the bookkeeper route. Don't do the H&R Block route. If you need to, join EBRHA, hire a CPA, hire the people, pay them the right amount of money, and get your questions answered. Because if you're spending $1,000 or $500 to get some really good advice, will probably save you God knows how many dollars down the road. So I think that's probably the best is because we can always tell you or give you advice here, but hire professionals. Same with evictions. Hire a professional to do eviction. Hire a professional to do what you want to do.
I,
That's
I
probably the cheapest, quickest.
just
Um,
I'll also chime in and go ahead. Sorry.
I was gonna say real quick, also too, when you are hiring a professional, let the professional know what else you're doing. I had a client that wanted to do a 1031 exchange. They didn't tell me that, but they were working with another broker on another property. They let the deal close, but you have to tell certain people that you want to do a 1031 exchange so you don't actually receive money. And you have to pay taxes on it because with exchanges, you kind of have to keep it in an exchange fund to transfer to the next property to avoid taxes. So it's very important to talk to the CPA that you're doing this, talk to the agent that you're doing this. The next agent, you want to do a 1031 exchange, a 1031 exchange felicitator, and all that good stuff.
Mhm.
And Steve, you mentioned something about borrowing to support their lifestyle. We have a question. Can you tell us more about how that works and why it's beneficial?
Well, it happens if you build up equity in an asset and usually it's, you have to. This is for people whose net assets are and their wealth is 5 million or more, usually 10 million or more. But you can develop relationships with banks. So that's one thing you do for flexibility is when you don't need money, you develop roads to have access to money. So you build your banking relationships. You always keep your credit score up so you can have access to funds. And you might put lines of credit or whatever in place that you don't even draw on until the time comes. But you want to have the flexibility built in before the emergency comes along.
Hmm.
But for the wealthy, for instance, I give you, people in Silicon Valley, they have appreciated stock, but the company's still private. they can go to a bank and they can borrow against that stock and as collateral. Or people that believe in Bitcoin, right? Coinbase will try to get you borrow against your Bitcoin. So, oh, you don't need to sell it. We can hold on to it and hope that it goes back up to 126,000. You can just borrow against it, which I think is a bad idea, but I'm not allowed to talk about it because the SEC doesn't allow me to talk about it. They know that it is. But
And
anyway, um, but basically, that's what they will. Yeah, that's what they do, though. They borrow against those assets, and a loan against assets is not. You don't pay taxes until you sell something, and also you don't make a profit until you sell something. So, there is sometimes when you, especially in stocks, you should take profits, but that's another story.
And while you're maintaining your property, obviously we're all anticipating depreciation, right? Just as a risk mitigation type of thought. And so how can you manage, capital gains and timing your improvements on the property to try to minimize the risk of too much depreciation when you're ready to sell?
Well, one thing that happens, I know that Felicia talked about having depreciated property. You can do an exchange to a new property where you get a new asset that does have you have a capital, in there you can depreciate against that. So that's one reason why you would do an exchange, a 1030 exchange, to start that depreciation window all over again. So that's something to consider. But yeah, but anytime taxes only occur there again when you sell something and you want long-term gains, you're in the lowest capital tax rate when you sell something after a year. So you get the lowest tax rate. But if you don't want to pay those taxes, then the way you do it is you have relationships with banks that allow you to borrow the money out. And for those who are working, they need flexibility. You can borrow against your 401k up to $50,000 from most employers, and that's flexibility you should think about for emergency pots or opportunities
That's
as
a good one.
well.
We've got a whole section I want to talk about retirement and kind of how to handle that too. But before we move on to that, we've mentioned a 1031 exchange a few times. Can you tell us in layman terms what is that, and is it beneficial while you're still looking to keep a property, or how does it work?
1031 exchanges can occur. It's beneficial from a financial standpoint, where if you want to, increase depreciation. Also, if you want to own a bigger asset than what you currently have to get greater appreciation, you can swap the equity into a new asset that might be, bigger than the current asset that you have, and that way you can keep scaling up in the real estate part of your balance sheet. But you can exchange like for like property, and you can only do it with real estate. You used to be able to do it with businesses and other things, just everything. But now, when the first Trump term, they made it so it's only real estate. So if you have a business, there's other things you can sell the real estate in exchange, but the business itself has to be sold differently, and there's ways to defer that taxation as well. But the you have like for like means that you have to get a property that's of the same value or more, and you have to have debt on that new property of the same value or more. If you have $200,000 worth of debt on your current property, you have to have $200,000 or more on the next property so there won't be any gain. And then if your property you're selling is $1 million, the next property has to be over $1 million. Or it doesn't have to be one property, you can split it up to three properties, but that total has to be over that. And then the other thing is you can't take constructive receipt of the asset. So that's why you have a financial intermediary in between. So you tell the title company that you want to set up with a TPA, they call it a third party firm administrator that will set up an account for you for the exchange. So you have 45 days after the sale of your property to identify new properties that you want to go into, and you have to close those properties within 6 months. I think it is
Oh,
6 or 9 months. I forget which one it is.
okay. And when could that backfire? Like when would a situation for a 1031 exchange like not be appropriate?
Uh, be- well, it won't work if you can't identify the properties that you want to go into, and those time
Mm.
periods pass, and then that's a broken exchange. At that point in time, we can rescue the defer. Can't rescue the exchange, but we can't do a deferral into a trust, if we contact in time. But everything is time sensitive, and you have to, you know, do stuff in advance before those time periods run out. But besides that, the only thing that can be bad if you go into a bad property. So if you exchange and you get into something that you didn't, if you're doing a direct to another real estate property, if you for somehow didn't look at something that was there in the building that you didn't know about, that would be bad. The in going into a Delaware statutory trust is where you go into a passive income because you're a part owner of a larger property. For instance, you're a part owner of a large Marriott hotel, for instance, or a combination of real estate. That is, you want to look at who's the manager of that, what's their track record, what track of success they've had. Have they You have to look at the debt on those properties, what those loans are, what kind of contracts they have with the banks that could impact the cash flow that you're expecting to receive or put your property at risk. You don't want to go into something that has a high level of debt on it, probably, if because that would make it more risky.
And when you're doing a 1031 exchange, if I heard you correctly, did you say there's a 6 month period where like the sales kind of have to work themselves out?
You're right. You have to identify the properties in 45 days. So that's the key.
Okay.
That can be. And then you can only go into those properties you identified. So if they fall through, and you can't close within that next window, then
Mm.
you're going to own the taxes on that building, but those buildings. But it is possible for you. I'm familiar with a tax and law firm that can develop a trust for you that you can do a deferral into a trust. That's a whole another discussion, but that would do the deferral, but that won't be an exchange. But those funds would be the taxation would be delayed, and those are funds that could to develop a passive cash flow for you, and funds that you could use to invest back into real estate.
And what about your other property, the old property? So if you identify and close on a new property within that 45 days, but your old property is doesn't sell in that amount of time, are you stuck paying both mortgages or how does that work?
Well, most of the time, people don't get an exchange until they sold the old property. That's when the time clock would start ticking. But I had
Oh,
heard of people identifying properties that they're interested in before they sell the property. But still, the time clock starts when the old property is sold.
I see. Okay, so it's all just kind of like it's like bang, bang, bang. It all kind of happens at the same time.
Correct. You should, when you know your property is going to close, you should start with researching, even before that, researching alternatives for where the money's going to go. And then
Okay.
you can name those alternatives once you're, ahead of time. You don't have to wait to the when the clock's out, but the clock starts when the property's sold, and then you have to close those. And things that might not close is getting if people were looking to close a property in 2022 and all of a sudden interest rates went up 3 times, that might probably affect their ability to get those deals done. So, those are
And
things
so
about.
we have a question trying to clarify on something we were talking about earlier. So anonymous attendee is asking about the conversation we were having about borrowing against your property to live, invest, or otherwise. And I think what we were talking about is not so much taking out a loan, but more so lines of credit or putting, investing in things rather than borrowing in a traditional loan because then you have to pay interest on that. So you're just kind of racking up immediate expenses, right? And so he's, the anonymous attendees asking, it seems short-sighted um, because you would take on monthly principal and interest payments to the lender on that loan when you're not in a position to need that, right?
Well, when I was talking about that, I was talking about people who are wealthy. That's how they do. If
Hmm.
you don't have these options to you if you're an ordinary person, if you're the, and you're not they call it it's a credit investor when you have more than $1 million of assets that don't include your home. The next level, I forget what it is, but it's $5 million and then whatever. So you have to be above that $5 million strategy to take advantage of those strategies. But for everybody else, yes, you constantly have to look at cash flows. That's the key.
Hmm.
Cash is the key. Profit is up to debate, or is debatable, but cash is king and cash is real. In hard times, you want to have liquid assets you can convert to cash, and the dollar is still king, no matter what some other people think. And even if you had gold, I mean, gold is great, I guess, but you still got to sell it, you know. And
Yeah.
I don't know how quickly that process happens if it's actually hard gold. If it's a security, yeah, you can sell that the same day. But so those are the things. So you don't want to borrow money. I think Felicia discussed that as far as anytime you borrow money in debt is risk. So you don't want to borrow money. You have to think about what that money you're going to use it for, and it needs to be something that's going to have a return greater than your cost of capital, which is the rate you're borrowing at. Right?
Yeah. And Gabriel, this one's for you. Are you in a market now, are you seeing trends toward consolidation, diversification, or exit planning?
I see a little bit of both, or I would see a lot of people that are consolidating, and this is 60 to 70-year-old. They're using this income for I mean, they're using the return on investments for their income to stabilize the lifestyle and things like that. Some people that want to sell, ready to get out of Oakland, but the market is not really there to get the price point that they want. And then I see people that are on the younger side, 30s and 40s, might have a duplex or a single family, and they want to start scaling their property. So it's a little bit of both, but both sides really just haven't pulled the trigger because they see the market what it is, and they want to see what's going to happen in the next 6 months to a year. So like I said, there's been a lot of countless owners that I've talked to that want to sell, but told me in a year or two because the market is what it is, and they see the taxes that they have to pay on this. They're trying to figure out, do I want to do a 1031 exchange? Do I still want to be in a property management building business? And also too, I've also referred a couple of different product types that Stephen was talking about. There's triple nets that is a very passive income style. Property as well. And triple nets are going to be big box like a Walgreens building, a gas station. I'm not saying you're operating the actual business, but you own the real estate, and a business occupy that space. And that's been a popular product type that some of my clients have been exchanging, doing a 1031 exchange into. It's a little bit more passive, not so much hands-on. And that particular product type does not have to be in your backyard, so you don't have to actually visit the property. So there's been people that bought Dollar General in the middle of Milwaukee. It's only $950,000, but they get the income from that particular product type. But like I said, also too, there are younger investors that are getting started, like Oakland, see the potential of it, see how close it is to San Francisco, so they see the value of investing into it now and seeing the appreciation. They might not get good returns day one with the rental collection, but they're going to see it's probably going to appreciate at least 50% within the next 5 years. So they're all investing in these particular product type. They can do the legwork to do property management, Oakland, things like that too. So I see a little bit of both with people just tired of Oakland and the laws, ready to get out, and then a new crop of investors that want to get in there and grovel up and not afraid of going to seminary or international 98, things like that, and investing out in those areas as well too.
Yeah. So I want to have a discussion around retirement. I know a lot of our members have property in Alameda County. 80% of the properties in Alameda County are 70 plus years old. It requires a lot of capital, a lot of management, a lot of upkeep. What does retirement realistically look like for rental owners? And what kind of options are there to transition from active management into passive income when they're facing all these challenges?
Well, For retirement, we all should know there again our lifestyle budgets and what that budget is like now and what it will be in retirement. And the key questions that you can ask yourself today, if I keep doing the things I'm doing, will I have to reduce my lifestyle in the future? Or will I have to work longer? Or, so those type of things you can do projections on the assets you have, what they can return and give an idea what your cash flow can be 10, 20, 30 years from now, whenever it is you're supposed to retire. Full retirement age for those who have Social Security is at 67 right now. You can get projections for that from the Social Security Administration. You can sign onto into your website. You got a personalized website with them and do calculations. Who knows if they're going to be around when or how long it's going to last? Because the politicians are always trying to spend your money, and it is your money because you've been putting money aside since your first job. For me, that was when I was 12. You've been putting money aside and that's been growing. They've been investing it and using it too, in many cases. So that is your money. But as far as for the real estate, then you have to look at, how do you want to continue to be active in managing your real estate? For those who don't, I had a client in LA that her husband built a nice portfolio, about 10 properties. He had a stroke. She was left managing something that she didn't know anything about, so it made sense for her to get out. And for that, we did exchanges into a variety of different diversified type properties that, the deferred the taxation, created a passive income stream for her, and still they are still benefiting from all the different benefits of real estate, but also created a large bucket of liquid stocks and bonds and commodities that will protect that real estate and protect the lifestyle of way into the future. So, she's the family's positioned well for both now and way into the future and probably two or three generations into the future. So, those are the type of things can be done. So the key thing is the assets that you have that you're actively managing. Do you want to continue to do that? If not, how can you get the same kind of income from it without causing a taxable event? So that's something we can work on. And then the other thing, you just want to have a defensible portfolio that can ride through the ups and downs of the markets. I have a chart on the markets, but the markets, they go up and down, but they go up. The economy is designed with capitalist, worldwide capitalist system that we're in is designed for things to increase, but with dips. And so you just have to have the portfolio so it can ride out the dips and to keep your boat on the water.
Thank you, Stephen. Let's see here. Thank you so much, Felicia. We really appreciate you and your insights. Have a great
I want
day.
to say, Jeline, you wanted to say something earlier, and I'd like to hear from you to your insights.
I do not have any insights on this topic. I was simply just following up on a question that did not get addressed, but we ended up addressing. Thanks, though.
Okay. All
Yeah.
right.
We touched on something earlier and it's come up again in the Q&A, so it's not quite, well, I guess it is tied to retirement, but is there a way for an individual to use a 401k to leverage real estate?
Yeah, you can do that. And, as financial advisors, we don't recommend that, but,
Why not?
well, combined, we're required by the FINRA and everybody else to be more conservative in our recommendations. But so, the 401k is for the future for retirement. Like that, we just had a question about dedicated boxes or accounts. So that's for retirement. So when you go against your retirement, and we have this discussion about, paying for college too, how much did you go against your retirement for college when you're at the end of your working years and your kids are at the beginning of theirs? Now, let them borrow money and they can pay off the debt. Yeah. So that's a discussion we have with clients, how much you want them to pay versus you paying. But the same thing for if you're going to go into an investment, because when you borrow against your 401k, it's not just the interest that you have to pay yourself to make it all work. It's about 4%, but it is also what that money could have made in that account. And basically the other thing, when you paying it back, you're paying it back with with money that's already been taxed. So you have to look at that as well. So where that money in account has never been taxed and it's growing tax free. So there's all these type of things you can do a calculation and then you decide whether it makes sense to do that. But I do believe in owning real estate. So if a person does not own a home, I bought my first home at 27. As soon as I moved to California, I had a gorgeous apartment and 1200 Lakeshore, 22nd floor, looking at the lake and the bay and the sun. It was like 2 bedroom, 2 bath, balconies all around. But I was out here one year and I realized, no, I got to own real estate. So I bought a house, and I've been a homeowner ever since. And that's the best decision I could have made. So for those who do not own real estate, then I think it's a great thing to borrow against that because that home will be a part of your retirement future.
Yeah,
But to do it just for investment purposes, maybe it's not. You have to weigh that for each individual
such a
decision.
great answer. Thank you, Stephen. I love that. We have another question in the Q&A. Is having the owner of a rental property move into and live in the property for 2 years to avoid capital gains a viable strategy?
I missed that one. If you live in it for 2 years, oh, rent it out.
No, yeah, I'm trying to let me reword it really quick. So if a property owner moves into the property and lives there for 2 years to avoid capital gains, is that a viable strategy?
Actually, it's the opposite way. You move out of it for 2 years and rent it out to somebody else.
I see.
You have to turn it into investment property. If you have a home, there's no such thing as selling your home without taxation. You do have a $500,000 or $250,000 uh, credit or whatever. You don't have to pay taxes on it as a single person, a couple $500,000. But if you have a property as a $3 million game, that 500,000 not going to help you much. So if you want to do it, you could move out of the property, rent it out for 2 years, make it investment property, and now you can 1031 that. Okay. Otherwise, you
Oh.
can sell it. There again, you can do the sell with I mentioned about deferring capital gains to a trust. I have clients that have done that. And so they're able to defer that gain, develop a passive income, and then they can also go back and buy some real estate with some of the money from that trust. Yeah.
So you can only do a 1031 exchange on rental property, is that what you said?
On investment properties.
An
Yeah.
investment. Okay, got
Yeah.
it.
Anything's an investment property. You can't do it
Okay.
on your home.
Hmm.
Yeah, those benefits of being able to exchange into another home went away a while ago. I think it was back in the 90s. Yeah.
Dang, I was born in the wrong time.
Yeah. Yeah, baby
Um,
boomers made a lot of money on that. One reason they got all this wealth today. But you
yeah,
millennials and whatever, Gen Zs or whatever you guys are supposed to collect it. Hopefully you'll do the right things with it.
I hope so. I'm gonna have to talk to you more about my future because who
Mhm.
knows?
And then,
Yeah.
you are born at the right time. There are opportunities right now. You're born at the right time.
Yeah, that's right.
Thank you. That makes me feel better, Walter. So we were talking, I wanted to take some from the Q&A, but we were talking about transitioning from active management to passive income. When should you start planning that transition?
Well, and planning sooner is always better. So
I knew you were gonna say
yeah,
that. Now,
because
yesterday.
thought is creative. So everything you see was a thought first. Somebody had a thought. The table you're sitting at, it was a thought in somebody's mind. So thought is creative. So the more time, whatever you put your attention on grows. It's just like watering a plant. Whichever ones you water, that's the one that's going to grow. Uh, so, um, so you want to get your thoughts on what you want in the future as soon as possible, and then you want to know what has to happen to get what you want, and then you want to start taking actions and talking to the right people in order to make those things come to reality. But the thought is the first step, and so the quicker you think about it, the quicker that it's going to be. I think the greatest thing that ever told me was taught to me when I was 19 is that I was a freshman in college having a great time. And these guys came along and said, what do you want to be one day? And I said, this. And said, well, I want you to know the person you're going to be in the future, you're now becoming. So everything you do today is going to affect who you're going to be in the future. And I'm like, wow, I can't party right now and be serious in the future. So, that was great advice. So then that started directing my thoughts and my steps early on, which led me to go to Harvard because my first uh, year in college, I pledged a fraternity Kappas, and it was not. I didn't my GPA wasn't as great as at the end of the of the year.
And what about resources? I know our team gets these questions a lot, where our members, they're tired. They're tired. There's a lot of changes they can't keep up with, and they need they need help. And so, we come up with resources. Obviously, we have, great partners that handle, management and day to day and things like that. But what other tangible resources could our members look into to just try to take a step back? Without maybe fully hiring a management company, what are some things that they can do to kind of prepare themselves to pass on that property?
Um, I'll speak to that. There's a couple different things you could do that can make your life just easier on a day-to-day management if you don't want to hire management. There are sources that could help you lease up vacant units. Maybe you don't want to go out there and do showings at 5 o'clock or 6 o'clock when people get off of work. You can always hire just a leasing agent just to lease up properties. There's online sources to collect rent, like Turbo 10, I think, is EBRHA's one, and the Zebo and stuff. But they have other different online sources that could be able to help with online rent collections and getting contractors out there to be able to service the different things. But just getting prepared for getting retirement age of property management as well too. To speak on the last question, just understanding what the future entails, who the if you are going to pass it down to your kids, make sure your kids actually want to deal with the property management of the actual property itself. There's been countless of times when mom and dad pass away, and now there's 3 or 4 kids. One kid want to settle, and two of them don't. So there's an argument that they don't speak to each other, and stuff like that, and they just don't want to deal with the ownership. So just talk to the heirs and see what do they want to do. Do they want to be left with this property or just cash out and enjoy the money right away? But definitely just look at the different resources of property management day to day, of just rent collection, online services like um, TaskRabbit to hire contractors for small jobs instead of you switching out light bulbs and stuff like that for little small jobs and stuff like that. There's a lot of different resources out there, depending on what the task is needed to be able to help you out with the day-to-day management.
Thank you, Gabriel. And Walter, we haven't heard from you in a while, so we've got a couple questions that I want to open up to you as well. The next topic that we're kind of leaning into is legacy and generational planning. When it comes to, planning your estate and getting ready to pass things to family, thinking about how that all goes. Gabriel kind of touched on the relationship piece. But what are some common mistakes that owners make in this transition period when they're looking to retire and pass on property that you can touch on?
Well, my knowledge is limited in terms of that area as compared to what Stephen does and Gabriel does. What I find in terms of common mistakes as persons are looking at legacy and handing things off are if the individual takes out financing that is short term that has to be addressed quickly, where we call it a bullet, a payoff that has to happen in a couple of years. Sometimes folks they get aged and their mental faculties start to diminish, and they start making decisions that aren't necessarily smart long-term decisions, and it's just something that they can do for convenience at that time. That would be one thing, but I think in terms of long-term legacy planning, the other piece is what Stephen spoke to so eloquently. What we're doing now will indicate where we're going to be in the future. So having a good team and making sure that one is addressing the issues that are going to come up proactively A lot of folks do that. Some don't, and when they don't, they they become a pawn, as Stephen said. But I'll turn it over to Stephen and Gabriel. I think this is something more in their area.
Thank you, Walter. It's just good insight just to see, we can do a deep dive on some of those things, but just, from a relationship perspective too, when you're passing property to family, um, there's a lot to think about. And, we talked about it earlier, just kind of getting into those situations with partners and things like that too. And when it comes time for you to step away, what does that look like? And how are you managing all of that?
Well, I just to talk about that. You want to make sure all the documents are there. In your case, a living trust. You don't want to go to court and have stuff probated. You want to make sure that on your retirement accounts, you have the correct beneficiaries for those accounts because those are permanent things that can't be changed later. But for real estate, so if you have a living trust and the property is in the trust, that means it's owned by the trust. It's in the trust's name, not your name. And basically, then the property would get passed over to who you you have in the trust, and make sure you got a good subsequent trustee who's gonna you can trust to do your bidding. And so those are the things. But just having a document in place doesn't help families when there's a family involved. Okay, so you need to make sure that if you discuss, especially your children, you're the nuclei of your family. Your parents are. So if parents disappear, that nuclei is gone. All the atoms start scattering and thinking about their own interests, many cases. And that causes a lot of property to be lost and a lot of value of that estate to be lost. So having this family meetings, discussions about, working together and plans or whatever can help those children get along better when they have this emotional thing of their parent leaving and and all of the things that they emotional dependencies they had tied to that parent now not there, and all the issues they had with their siblings starts making an inability for them to work together. So you have to work through those things. Um, and that's it. And really, families that successfully do that, they have a commitment to something bigger than themselves, usually to the community and to the family's values that they are continuing from the ancestors and that they gave them the opportunities to do that. So I've just saw in the paper recently that somebody in New York blew $5 billion estate to stupid things. I can give you example of very rich people who destroyed an estate through their infighting, or you can give examples of families that do very well. In-N-Out Burger is one. It's on the seventh generation. So it's really about valuing each person in that family. Investing in whom they are as a person, having a understanding of the family values, understanding the family's commitment to the community, and having a decision making process to deal with conflict. That they agree to process for them to work together. That the family's values and mission is bigger than their little grievances or whatever. Okay.
And what about tax implications when selling property to family?
Well, that's the great thing about taxes. The wealthy don't want to give any money to the back for poor people to gain rung on the ladder. That's why that 5% tax in California probably is not going to work. But but basically, the way the tax laws are written, which they're written for the wealthy, they're not written for the pawns in the life game, and including that big beautiful bill, which there's some things you need to pay attention with that. But basically, it's everything gets a step up in basis. So after the parents to pass something on to you or whatever, you have a new basis. It had a basis of $1 million, but it was worth 20 when they died. Well, it's worth 20 million now. So if you sell it for 20, there's no taxable gain. If your parents sell it, there's a 19 million taxable gain. So that's the great part about it. Other tax considerations, there has to be a return filed, so there's be taxes for that, the income for that year. But besides that, there's really, and then there's estate taxes really start now at, I think it's $11.5 million per person. For a couple, that's then would be 23 million. So most people aren't, their estate's not going to be bigger than that. So that's a small amount. That it was state taxes before, and they really got put in place in the last time where we had a lot of accumulation of wealth at the top with the robber barons around the 1900s. If you have accumulation of wealth in any society, that tends to destabilize democracy in that society. So you have to figure out how to break up that wealth and get it. You can't have it just, stay in any kind of concentration like that, because then you start having these situations like we have today with elections being paid for and everything else, and our Congress being bought. So, so for estates that are over 23 million, that tax to transfer over will be up to 40, I think, well, 47%. And you can't do anything about that. And nothing should be done about that. They're going to still have enough money left over afterwards. But that's the kind of return. And they made that wealth a lot off of you and me. Like I said, it's a capitalist system. The system's designed to make money off the pawns in the games of life. They made a lot of that money off of government support, government benefits. And so that should be given back. And a lot of that money was made without consideration of paying their full cost of the making the money, which is for instance, is our environment. Most corporations do not pay their full cost of what they do to the environment to create that wealth.
All right, well, we are at time. Thank you all so much for your insights, and thank you to the members that came today and asked questions and made this such a great conversation. If you have any other questions, please feel free to reach out to us. Like I said, we will be putting this recording up in the next couple days on the website, so you can have that for yourself as well for members. And for guests that are still with us, please reach out to us if you'd like to join or learn more. Stephen, Gabriel, Walter, and Felicia, thank you so much for your time and your insights and expertise. We really appreciate having you in our community, helping our members grow their portfolios. Appreciate you guys so much.
Okay.
Great.
Thank you, guys.
Take care.
All right. Thank you. It's been
See
a
you guys
pleasure.
soon.
All right.
Good
Bye.
Good job, Danielle.